Hey everybody, this is Jose Blasco. We are about to get started. As always, I would appreciate a quick message on the chat box. A quick hello would do. That way I know you hear me, sound is good, and we are ready to get started. So we are just starting in just a few seconds. So please go ahead and use this time to have a quick confirmation on the chat box with a quick hello. That would do. I will turn on my video stream in the meantime, so I can position myself as always in the bottom right side of the corner. That way we can be a bit more interactive somehow, isn't it? Siderman, thank you so good. Thank you so much. Maka, how are you? Very good to see you guys. Very nice. Very good. 1 second to go, guys. That's it. So the session is now officially started. We are live today. It's July 1st, 2021. Welcome to Options with Options. We're going to continue what we started yesterday. Yesterday we started looking at various market opportunities. Today we will continue with that, looking at more options trades in the market, as well as managing the trades that we have already in our accounts. Christian, very nice to see you as well. Very nice, everybody. Perfect. Okay, so highlighting the disclaimer very quickly here on the upper left. Read it carefully, please. This is important information. Do not skip it. Again, it's not too lengthy, isn't it? So read it carefully, guys. It's indeed important. As we cover the disclaimer, I would like to move into the agenda. The plan for today is first to say hello to everyone, we just did. Then remind you that we are simulcasting. So depending on where you are watching the session from, could be LinkedIn, could be YouTube, could be Facebook, etc. or our private room in our website, tradewithufos.com/live. So depending on where you are attending the session from, you may experience slightly different video lags. And keep that in mind, especially when it comes to interacting with the chat box. It's always convenient if you are trading that you have your trading platform in front of you as well, so you can compare your charts and my charts. And again, you may notice, let's say 10-15 second delay depending on where you are in the world, okay? Keep that in mind. So let's begin. We're going to look at the markets. We're going to look at the trades that we have already running and talk about management. And then we'll get into identifying new trading opportunities. So let's begin, everybody. Okay, let's begin. Here we go. Here is TradeStation. And we will start with looking at the S&P, which is moving higher. As said yesterday, is not a very big surprise, isn't it? The climate yesterday, we analyzed the climate for the S&P. The climate yesterday was 6 out of 9. Today, of course, is one day more, so it's 7 out of 9. And again, those are statistics which are obviously very relevant. In the other hand, they mean nothing without the UFOs. So what we can see, we saw it yesterday and today we see it again, is that UFOs, green-colored UFOs, are forming as the market is moving higher. That implies that if the market was to try to fall and change direction, it would hit those UFOs and typically bounce. Therefore, in a situation like this, statistics are very likely going to become reality. If you had no UFOs at all, so then probably not. But it's in this case, it's not the case. Okay, so we're going to be looking at directional opportunities later on because the S&P is making all-time high. And we've enjoyed this many times, and every time the market creates those opportunities, it's good to find the right stock to participate of them. Okay, so we'll be working on that. Before we get into specific opportunities, I also want to look at the VIX. So the VIX measures the current level of premium in those options, the ones that belong to the S&P 500 index. It's an index, it's an average if you wish. So currently the VIX is trading at 15.51. It's 2% lower than what it was yesterday. Nice, because if you recall yesterday, we were planning trades on Broadcom and MPC. I did get filled on the one with MPC. I never got filled on the one with Broadcom. So in other words, in my portfolio now, I have MPC and MDT and Goldman Sachs. Those are 3 iron condors. All of this is negative Vega. Okay, and I have PayPal and AMD, which are two double calendars, which are positive Vega. So I am a bit, biased towards the negative Vega here, and I would like to neutralize my portfolio So I'm gonna be looking for another double calendar today and see if we can find that. And the fact that volatility is dropping by 2% today may allow me to enter my double calendar with cheaper options, okay, which is something that, if possible, will be appreciated. So this is where we're gonna start today, given the current market conditions. From a trade review point of view and what we have in our accounts so far, I would like to go one symbol at a time and first point at MPC and notice how I got MPC here in my account. Okay, so we got filled. This trade was filled in my case at 75 cents. Yes, Maka, I do plan to do that as well. Yes, absolutely. And by the way, Maka, I totally forgot yesterday to address your question that you sent in an email. If you don't mind, and you could copy and paste that email on the chat box, I have no problem at all also to find time to address your question. I guess I got distracted yesterday with the trades and I never got back to you on that. Okay, so please feel free to do that so we can talk about it today. Okay, Maka? Yes. So anyway, MPC, I got filled at 75 cents. So if we go back to, oh, not this one. If we go back to the chart, and also I want to load OptionStation Pro. Okay, well, you can see MPC is up 1.26%. Okay, so that stock gapped up by 1.20%. So of course, this is gonna create an impact. And the initial impact that you can see is that the trade, it's showing a little bit of negative P&L, negative $22. Again, that's not an issue. It's part of, you know, absorbing the ups and downs that will take place as that stock travels and does its thing as we approach the expiration date on July 30. So all of this is a normal thing and it's fine. Joe, I'm using the email jose@tradictiv.com. Joe, jose@tradictiv.com. Mark, you were filled at 78. That's very good. Much better than me. So good job there. Maka also got it. Wonderful. Perfect. Great. Love to hear, guys. So let's go. Let's get to analyze this trade. I'm gonna have to change this to 75, which is how much I got. Some of you are a bit better than me here with a bit more credit. In my case, I'm just gonna simulate what I got. You know, if you were able to exit at the midpoint, the loss you would get is actually $15, which is a bit less than what Thinkorswim shows, but it's okay. It's about the same. So we are in this position now where we are accumulating $2.70 of time decay per day. And again, as long as the stock stays in the range, so then we're gonna be okay. Okay. But of course, we have trade management rules that we need to discuss, isn't it? And one that could be concerning, isn't it, is the fact that the dotted line yesterday was already quite close to the upper solid line. And next thing you know, even though we've only been 1 day into the trade, this already gapped 1.3%. So what are the new levels that are expected for the range to be? So the bottom part is 56.31. That I'm just starting from the place where it's not a concern. Okay, 56 something is here. So, okay, but what about the upper part? Well, the upper part is 66.64. And this, I believe, and it does, I'm just moving the wrong drawing element. I was moving the UFO. I meant to move the purple area. So 66 point something is above the dotted line. So actually, while we've been in this trade for 1 day only, it's time to discuss management, okay? It's time to discuss management, okay? And what we want to do and the rules that we have imply that, okay, so instead of leaning against the bottom UFO that was setting the bottom part of the range, we can lean on nearer UFOs as long as they are still below the dotted line and still give us a setup that implies at least 2 green UFOs, okay? And that's unfortunate because we have 1 and 2 UFOs. There are only 2 green UFOs. There is no more UFOs. So, and by the way, even if let's say there was another green UFO here. So if that was the case, it would not count because having our bottom part of the range here means that we would not be surpassing the dotted line. So that would not work either. Okay. Ideally, you know, there would be some other UFO somewhere here. So now we can draw the line here and that's 50, let's say 55. So we would now roll the 54, 53 to be 55, 54. And that way lock in some profit, get a bit more premium, and get ready to defend yourself against that stock, potentially breaking the range. That was not a possibility based on statistics yesterday, but it is today. But again, the fact that we have a triggering condition to manage the trade doesn't mean we are just going to do it just because. We still need our rules to be met, because the other thing that could happen is that that market now hits the red UFOs, and from there just falls like a rock, okay? And next thing you know, a few days later, it's below the dotted line. So again, the dotted line are references. They are not like, it's not like a concrete type of wall that is a very solid line that price cannot surpass just because it's there. It's just a dotted line, which is a reference. What is stronger for the market to react to it and turn are the UFOs. So this ultimately is the most important part, for you to lean against when planning on your trades. So anyway, there is a bit of danger kicking in this particular market, but there is no possibility for us to do anything. So let's say the market was to, and this is a question for you guys, be ready to answer. Let's say this market was to just like rally like crazy all the way, okay? And no other green UFO is formed. Let's say you got another green UFO here, another green UFO here, another green UFO here. So you have plenty of green UFOs, that's great, but none of them is below the dotted line. The one below the dotted line is still 54.20. So what would you do if price breaks the upper solid line and no new UFO was formed below the dotted line? What would you do? That's the question, okay? Because so far the instruction is we do nothing. But what if the market was to rally and surpass the upper line? So question for you all guys, okay? To see if you guys are with me when it comes to the methodology and the various steps that we need to take to manage our trades, okay? So I'll let you type and I will come back to the answer in a minute. In the meantime, I want to take a look at Medtronic as well. So with Medtronic, that stock is also 1.2% up, okay? So it was much lower yesterday, today is much higher. So let's take a look at Medtronic and see what probability suggests. Probability suggests 131.21. So 131.21, that would be something like that, something like that. So 121 is here, 130 is here. So something like this. So we are still good in the sense that statistics suggest that there is no risk in front of us, at least at this moment in time, and therefore we should be okay. Yes, Christian, we should roll up the puts, but remember, to roll up the puts, you need UFOs beyond the dotted line. And with a prior trade with MPC, my question was, what if it rallies all the way and surpasses the upper part of the range, and there is no green UFO below the dotted line, but the one UFO we are already using at 54.20. So, you cannot roll the puts like little by little because there is no UFOs, right? No green UFOs below the dotted line. So what would the action be? That's my question. Okay, what would the action be? In the meantime, I'm going to go take a look at Goldman Sachs. Okay, and I would like you all to participate on the answer, my friends. Even if, let's say, you give the wrong answer, it's fine. We are here to learn, isn't it? So you guys go ahead and comment. So that way the session will be more enriching for you guys. So Goldman Sachs, what's going on with Goldman Sachs? So Goldman Sachs today is 0.7% lower than yesterday. Yesterday was, the upper part was a bit challenging. Now the expiration date for Goldman Sachs is July 9, is a bit closer in time. So let's see what happens. If we look at Goldman Sachs, from a probability point of view, it says 390, 365. So let's take a look at 390 and 365 and look at that. We got 390, which surpasses the upper, okay, and did I say 65? Let me be precise now, because now we got something to do here. 364.34. So 364.34 is something like that. Something like that. And therefore, if we were to lean against another UFO, it's going to have to be that one. Okay, it's going to have to be that one. I'm probably gonna end up using that one for the roll, and you will see why in a minute. But probably that's going to be my choice. Okay, so again, you want a UFO below the dotted line. In this case, we have multiple UFOs. You have that one, that one, that one, and they all qualify for a roll. Why? Because we got our rule met, which is at least 2 UFOs below, right? 1 and 2 and 3 and 4 and 5. Okay, so we got plenty of UFOs, so our rules are met. Very good, Maka. You got the answer right. You go directly to an iron butterfly, which is the most defensive step. Unfortunately, you cannot build into it if that's the case, which gives you a much greater benefit. But if you have to defend, you have to defend. Because if you don't defend, basically what's happening is that you're just exposing yourself to, you know, let's see how strong the slap is gonna be. Is that making sense? Even though we have the risk under control since the beginning of the trade, since iron condors are a limited risk option strategy, we know exactly what's the worst case. But you know, again, you don't wanna basically be hoping that things are gonna be okay. You want to act when it's time to act. Okay. So yes, you got the answer right. I'm very happy to see that. Good job. And now let's work on rolling this trade. So why did I say probably I'm going to use 361? Well, because I'm thinking, maybe I'm wrong, but let me take a look. Using July 9, when we look at the expression, the strike prices available, we have 262.5 and 360. Okay, 262.5 and 360. And if I look at that UFO, the one before. Well, actually, I was wrong. It's 362.78. I thought it was lower than that. So actually, if we use the 362.5 right below this guy, it's actually a very, very nice location. Okay, and again, I thought it was not the case. So perfect. So this is where we're gonna have our line, and this is the roll that we're gonna execute now. We're gonna be closing the 342.5 340. And we're gonna roll it up. Okay, we're gonna roll it up. So we are now selling the 362.5 put and buying below the 360 put as a protection. That way we lock in the profit from the below puts. We collect additional premium to start getting slightly defensive in that building up the defense, right, mode. And then we're gonna analyze all of this in the option chain, in the simulation tool, so you understand better the impact of having done this. Okay, so I'm just gonna duplicate my iron condor. Okay, so analyze, duplicate, trade. I will uncheck the one I have above. Okay, and what I will do is I will pretend that I already done the roll, which is 362.5, 360. Okay, and the question is, if I do that, how much more premium am I gonna get? Okay, so let's go back to TOS and select our puts and select create a rolling order. Okay, so here it says selling a vertical, and here is gonna give me different expression. Wait a minute, I think I'm using MPC. Very big mistake there. Careful with that. We are doing Goldman Sachs. Okay, so I'm gonna use the puts, right click to create a rolling order, sell one vertical, and as I was about to say, it's giving you different dates. That's not what we want to do. We want to use the same date. Okay, we want to use July 9. Okay, so that vertical roll, you know, it's just forget about what it says there. So we're gonna use July 9 all the time. Okay, but the one difference is that we are gonna be buying the 360, which is a higher strike, and selling the 362. Okay, so let me review. I'm doing this right. So if we do this, okay, if we do this, I sell the 362.5. It's a put expiring in July 9. Below, I buy the protection, which is buy the 360 put expiring July 9. And as I do that and I collect more premium, I'm gonna have to close the puts that I have below. So the 342.5, which I am short, I'm gonna buy it back, so +1. And the 340 that was the protection, which I bought as a protection, I'm gonna sell it. Okay, sell it to close it. So if I do that, this is gonna pay me 20 cents of additional credit. In other words, if I go back to the simulation, that means that this trade that initially cost me 38, if I add 20 more cents, that means that this trade now would be in a position to pay me up to $58 instead of up to $38. So basically I'm collecting additional 20 cents, to defend myself in case in the end I'm going to be hurt on the upper part of the condor. Okay, so the trade is valid. Okay, the trade is valid, and therefore the roll is to be executed. So I'm just gonna go with it. Here it says, let me do one last thing, just to try to measure real time as precisely as possible, the beta spread and everything else, and be more specific with the instruction on, when placing the order, how much to get filled at and things like that. So we are selling the 362.5 and buying the 360. Here we go. So this is 30 to 21, so it's relatively liquid. 26 is the midpoint. Yeah, so 26 is the midpoint, and we are spending 6 cents to close the the bottom units. So I think it's fair enough to go for around 20, maybe a bit more. I think it's okay. Okay, I think it's okay. So let's do that. I'm gonna go for 20. You guys, if you want to try maybe 25 and wait for a little bit and see if you get the feel, that's fine too. In my case, I'm just gonna go for 20, so I don't spend too much time on order placement, so we can look at other trades as well. Okay, that's it. I just got filled at 23 cents. So that means that my new simulated position actually got 3 more cents of credit. Okay, so that's 61, and this is now the new trade in which I am in. It's a new converted iron condor where my net PNL is 15. Okay, that's the net PNL of this condor. On Thinkorswim it shows -5, but of course it shows -5 because we just collected a profit from the below puts. So if you put it all together, it's telling you plus 13 is your real-time PNL right now. Okay, so we are just going with the flow, protecting this position, adapting to the market condition as we are approaching July 9. So you guys, let me know on the chat box if there are any questions, because I am trying to move quickly into the other trades so we can get into not only managing trades but also getting new trades in the account. Maka, if we leave these existing puts, then they will expire worthless, so why close them? They will expire worthless as long as the stock stays above 342.5. Let's pretend instead of rolling, which means closing those puts, and now you sell these puts above, okay? Let's say the stock, now just collapses all the way. So then you're gonna get the loss that this spread involves, plus you will also get the loss that this spread involves too. So basically, if you leave them, in one hand, you could say I have a very strong probability that they will expire worthless, because look at how many UFOs and how far it is and all of this. That's true, okay? But what if the market really crashes, like it does from time to time, okay? So then you have double the risk in the trade. So how do you, instead of having double the risk, how do you reduce the risk and get in defensive mode? You have to roll them, and therefore you have to close them, okay? So that's what it is. Now you may tell me, okay, I'm just gonna close the 342.5 because it's the one creating risk, and I will leave the 340 open just in case the market collapses like it's crazy, and now that 340 put is gonna pay me well. Okay, I could see that, as an option for you, and then you may want to leave the 340 put, but certainly don't leave the 342.5 put if you sell the upper spread, because then you just assume double the risk on the trade, and while it's unlikely, the risk is there. Okay, so keep that in mind. Maka, very good question. So yeah, so very good. So we have all the iron condors, AVGO, which was the other iron condor we planned yesterday, we never got filled, so I'm just gonna delete this trade, forget about it. Lily is doing his thing. Of course, Maka, very good question, love it. Lily is doing its thing, is moving higher, 0.2, 0.3. So Lily, we have it here in the account, is currently making $468 per contract. So so far so good. We let it do its thing. Remember, this is a trade where we could not lose anymore. And then we have two more trades to analyze, which is AMD and PayPal, which yesterday we could not really do much with them because we were trying to do a roll and we could not. Okay, and very nicely, PayPal is falling very hard today, which probably is increasing the implied volatility and therefore helping us to do a more efficient roll than what we would have had yesterday. So well done by not doing the roll yesterday, isn't it? So PayPal, for the ones of you that were not with us yesterday, PayPal is a double calendar trade, even though we are missing the short puts, given the fact that the short puts basically give no premium since the 230 strike, which is the one we're using, is so far away. So right now we are only short the call, even though we certainly want to review the call and the put to see if the put is paying enough today, probably not, and see how much we get for the roll on the call. So let's take a look at the put on PayPal. We're going to be looking at July 9, isn't it? So the 230 put on PayPal, it's going to pay 2 cents. Okay, so forget about it. I guess it's fair to say that we are just going to forget about the puts for this trade until the end of the trade, which is July 16, given the fact that, you know, the market moved spectacular. Okay, that was absolutely amazing as a move. Now the 260 call, that one has surprisingly less extrinsic value than yesterday. Wow, I'm quite shocked about that. I am quite shocked about that. Let me try to get this in Thinkorswim and pretend we're gonna do the roll by closing the July 2 and selling the July 9. So close, roll. So we're gonna get 10 cents, okay, which is better than 7 cents yesterday, but it's definitely very disappointing. Now it's 8 cents. Okay, good. So my friends, here's the instruction. Okay, we're gonna do something new that we have never done before. So listen carefully. You may need to watch the recording again before you do it tomorrow or Monday, just so it's clear, because this is something new. But I'm gonna try to explain it quickly because I want to find time for the trades. Okay, so what's happening here? Well, what's happening is that the 260 call is extremely deep in the money. Is $16 in the money, which is not an issue. We have the risk under control. If you look at the risk profile, you know, we know where we are. Okay, the most we can lose is 371. That's the risk of this trade, and you know, if the market comes back down, we can certainly profit very nicely. So we are just letting the market do its thing while we are in this position. But while that's the case, we are now getting to the time where it's time to do a roll. But what's the problem? Well, the problem is that I cannot do a roll. Why? Because doing a roll would basically get me, you get 15. Yeah, it's I would say it's better than nothing, but it's not too attractive, Maka. So I would kind of suggest to do what we're gonna do, even though there will be a margin implication. So let me explain it first, and then, you know, maybe you have the answer there. Okay. So again, if I roll it now for 10 or 15 cents, the problem is that I need to pay commissions for that, and then I'm going to be left with an extremely tiny advantage. It's almost better to, you know, basically end up with no position, and now if that stock, you know, keeps going up or down, now it's basically you have a very cheap strangle, and you know, you probably make more money like that than just by selling and collecting 15 cents. So you know, that's one option to consider. Okay, now in any case, I would like to get that 260 call filled, but you know, let's say that call is gonna pay me you know, 20 cents or whatever, so I don't want to get it filled this way, and then suffer so much in commissions, where in the end the credit I'm left with is so limited. Okay, that I want to avoid. So one way I'm gonna suggest to go is to go through assignment. Okay, and specifically, purposefully go through assignment. Now, it's gonna be great, okay, super great implications of accepting this assignment, okay, when it comes to margin and when it comes to P&L in the account. So take a look. If, let me do this. I'm just gonna move this to July 9, which is what we would want next Monday. So let's say I accept the assignment, okay? So if I accept the assignment, okay, here is gonna show that I got $2,350 of profit. And it's absolutely not like that, because if I get assigned, the one thing I don't see here is the short shares I'm gonna get. Okay, so let me analyze and sell 100 shares together with what we have. Okay, and by the way, if I was to get assigned short shares, I will get assigned shares at 260, which is the call that we get those shares assigned for me. So I'm gonna have to change this to be 260, and when I do that, that means that now that stock position is gonna produce a very important level of pain in my account, and this level of pain in my account, together with the $2,000+ the long options are paying me, is gonna bring me back to the P&L I have, which is slightly under 200, isn't it? So if I go back to the same position I had with July 2nd and -1, so it says -12. So the difference between -12 and -312, the difference between -312 and -309 is the time decay, is the extrinsic value left in the option, right? So if I let it expire and I'm assigned, so now the option is gone, this is making 2,375 for me, but the stock position now that I'm short 100 shares at 260, that's showing $2,685 of pain, right? And if you put them the two together, so basically it brings you down to that minus 300 something, okay? Now, so what am I saying is, number one, if you go through assignment, and let me explain first the implications and then why would you do that. So if you go through assignment, the first thing that is gonna happen is that first, you're gonna have to, you will look at your account on Saturday, and you will see 100 shares with a P&L of minus 2,678. And, you know, if you don't know that's going to happen, some of you may be like, oh my God, what did I do? Well, it's normal. Okay. Why is it normal? Because, you know, you took the pain from the short call, which against the profits from the long strangle, you know, gets you in the same position that if you never got assigned. So it's the same thing, right? But you will see that in your P&L. By the way, this is to be closed on Monday. Okay, so on Monday you would close the shares because on Monday we would do something else. But now, the other impact of doing that is the margin. So if you get short 260 shares times 100, that is gonna consume in a cash account. When you cannot be short in a cash account, in a margin account, it's gonna use $13,000 of buying power. So you need to have that capital available in your account to go through what I'm about to explain, because if you don't, then you're gonna get a margin call. So make sure you have that capital available in your account. I don't mean that amount of money in the account, I mean that capital available, freed up, okay, not in other trades. So when you get assigned, then you don't need to go through a margin call, okay? So if that was the case, then roll for 10 cents, roll for 5 cents, roll for whatever it is, so that way, you know, you will avoid that problem. But if you could go through assignment, so then that means that you will now be using $13,000 of your money. On Saturday, you would be netting minus $300+ of loss at that moment in time, even though the stock trade would show negative 2,600. As long as you're okay with this, because, you know, again, it's just math. It's okay, even though some people get very emotional about being assigned and things like that. It's pretty contained in our case, because you would be assigned, you know, that 260 call becomes short 100 shares, right? But you are also long a call, okay? And basic options knowledge tells you that when you are long a call and short stock, Okay, this equals the same risk profile of being long a put. Is exactly the same thing. So no one gets scared about being long a put, but many people get, very stressed about being a sign. There is no reason for stress because you have a long call. So you are actually equivalent as being long a put, but it will use $13,000 of margin, and therefore that capital needs to be available. Okay. So now let's say you are okay to do that, and you do it, and now is Monday. So what happens on Monday? Well, on Monday, you're going to turn around and you're going to sell the July 9, call. A few things could happen. Okay, a few things could happen. The market may drop. So what happens if the market drops, right? If the market drops, let's say the market drops, currently the market is trading at 286. Let's say the market drops to 285, right? So what's going to happen? Instead of closing your short stock position for $2,600 of pain, you will close it for maybe, $2,500 of pain. So you will save $100 of pain and then sell a call, and then you're going to be in a better position. What's the other downside? Well, the other possibility is that the market rallies. So instead of closing the stock for $2,600 of pain, you may have to close the stock for $2,800 of pain. But what's the beauty? Now you're going to sell a call, and that call is going to pay you more because the stock is higher. So again, it's pretty reasonable. You are offsetting the various risks attached to the trade, because while you are short shares, you are long the call, which is equivalent to being long a put. Okay, so it's not a big deal, and there is a potential benefit, which is by doing that. Number one, on Monday the market may drop, and right at the open you close the shares, and now you just collected less pain that you would have with the shares, and now you're going to sell a new call and be back to this position. But now the new call you're going to sell, the new call you're going to sell on Monday is going to be the 260 call that is going to pay you, if it was today, it would be 2,685. So in other words, you're going to collect in premium from that call almost the same amount of pain you got from the shares. Is that making sense? So you kind of neutralize the problem, and that will put you in a pretty okay position to either end up with a loss or a profit in this trade, but if the loss will be one more time reduced, which is what we have been doing every time we've been tweaking our double calendar during the life of the double calendar. Now in this case, I'm adding one more step, which is, okay, because the roll is not so juicy when it comes to how much premium you're going to get by doing the roll now. So let's go through assignment, save yourself the commissions, try again on Monday, and there is a little bit of crossing fingers, of course, but it's crossing fingers while the risk is contained. So if the stock drops, now you're going to be able to lose less on the shares after the assignment, and sell a call and offset the position better. It's, in my mind, it's a more intelligent approach than doing the roll now, but it does require $13,000 of capital available now. Well, not now, on Friday when the market closes. Okay, so keep all of this in mind, and I guess you're gonna have to take a decision about it. My decision, having capital available, would be to do that, and therefore what I would do is leave that call alone. Okay, leave that call alone, and then what I would do is find the July 9 260 call, okay, and place an order to sell it as a single option. But you cannot do that until you close the stock. Okay, so my recommendation is to do this manually. Just be ready to be there when the market opens on Monday. So close the shares manually and then sell the call manually. You could certainly automate that execution with Thinkorswim, but I guess it's it's gonna make it very difficult for the session today. We will not have time for much more if I need to explain that. Okay, so do it manually Monday as the market opens, close the shares, and sell the 260 call with July 9 expiration, which is the next one in line, on our way to July 16, which is the final expiration. Let me know if this is understood, and if this is not understood, you have two choices. Watch the video again before tomorrow, so it's understood before the end of the day on Friday, because you will get a sign at the end of the day on Friday, okay, right? So make sure you understand that. Or roll. and the role will not be that advantageous, but that way you avoid the assignment and you give this trade another week to work. Okay, that's it. Now, what about AMD? Long conversation. Okay. By the way, you guys let me know if again, this is important. The recording is available, but let me know if you need me to re-explain anything. So what else do we have? Okay, we have AMD. AMD is a very similar trade, very similar situation. So if we look at AMD and we look at the 85s, they have 14 cents of extrinsic value. If we look at July 2 and we look at the 85, they have 10 cents of extrinsic value. It's almost copy-paste, really. It's not ideal. We prefer to do the rolls the way we do the rolls, but it's almost the same story. So if I look at the 85 call and I try to roll it, it's going to give us 12 cents. Okay. So again, it's not that advantageous. Okay. Now, in the case of AMD, I may go ahead and say, let's do it. And you'll see why in a minute. And again, I hope I remember well. Yes, I do remember well. So why am I saying let's do it? Well, because with this trade, right now, after all the tweaks we have done during the life of the trade, the cost of this trade is 8 cents. In other words, the most we can lose with this trade is $8. Okay, that's the most we can lose with this trade, $8. Okay, so if we tweak it one last time, okay, if we roll it one last time, and we get 10 cents, 12 cents, so now this trade is completely out of risk. Okay, so I mean, it may be a better choice to do it on Monday, just like I have explained for PayPal, but PayPal is far from free of risk, where AMD is very close to free of risk, and therefore, I mean, at least that's my my mindset as a trader. If I can be out of risk, I love that. So I'm just gonna act on this trade to be out of risk. Okay, so we will accept the roll. I will take whatever is possible here. You may be able to get more if you are patient. Maybe you can start with 15 and see if you get 15. But I'm just gonna go for 10. So hopefully I get filled quickly, and that way I don't spend too much time with order placement. So I am a bit more efficient with the session. Okay. So now, if I do that while I'm waiting to get filled, so what would happen? Okay, well, let me, okay, I need to do this. Okay, I cannot duplicate unless I do this. Okay, just give me 1 second. So I duplicate the trade. This is actually 0. I'm gonna compact and uncheck. And now, assuming I'm going to get filled, so that's going to be July 9. Okay, July 9. And this is going to be a 0. We have no puts. Okay. And instead of 008, so if I get 10 cents, this is going to be a credit of, it's going to be a credit of 2 cents. So in other words, you cannot lose. Worst case, you make 2 cents. Okay. And now if the market goes back down, so this trade could pay about $150, $160, assuming the market moves down, graciously towards the 85 strike. No idea what will happen in the future, of course, but at least in this trade you cannot lose anymore. So in this case, I certainly think with my mindset that the right choice is to go ahead and go for the roll. Okay, I have not got filled, so I want to speed up this. Don't do this in your account. In your account, take your time. I'm just gonna try to get 8. Okay, see if I get filled. If you guys get filled, please report on the chat box how much you got, so we can go ahead and share that information, guys. Prashant, a pleasure to see your comments. Yeah, well, I'm more concerned about, I'm just thinking risk. I'm not even thinking delta, okay? Because this is not a directional trade. What I'm thinking really is that, hopefully earnings announcements for the stock are approaching, and hopefully we'll have an increase in volatility, and this trade is loaded on Vega, and then that's how I will get paid the most, more than neutralizing the delta, okay? which is very easy to be done, to be honest, in a trade like this, because this trade is positive gamma, so you can just get shares of stock against, but it would get plenty of margin utilized. Okay, it shows 5. Okay, wow, yeah. So we'll see. Okay, so let's be patient, and in the end, you know, worst case, you can always apply to AMD the very same thing I have explained to PayPal, and it's fine. Okay, and it's okay. Okay, so it will not be a big deal. But again, just think about it in your own time, so I can now focus on at least finding a trade for our account. And I would like to look at what the scanner picked when it comes to directional and non-directional. And as you can see, directional to the short side, I got nothing. Directional to the upside, I only got 3 symbols. So when I run the scanner, to be honest, I was a bit disappointed on how very few symbols I got. But of course, it makes sense. The fact that the S&P is making all-time high means that many stocks are doing that push when the market begins doing all-time high, and therefore many of those markets are not really in the condition we appreciate the most to buy them. Okay, so we need to look at it more carefully. So Nike is a trade where we are currently 7 candles in that climate, where statistics suggest 6 is the normal thing to happen. So getting in here is what I would call being late to the party. Okay, so we're gonna pass. And then we got SPLK. So let's take a look at this one. This one is 15 out of 7, so not ideal either. And then we got SKT. Okay, which this one is 2 out of 5, so that is acceptable. Okay, that is acceptable. The only thing I'm not super happy is that, you know, the price of the stock it's $19. So I mean, it's gonna make the trade relatively cheap, but also if you want to make, you know, decent returns, you may end up you may need to utilize multiple contracts for the trade, because it's a cheap stock, so you need more contracts if you want to have an equivalent risk and reward. But anyway, it's what it is. So we're going to look at this one. We have learned well, and we have seen examples consistently where improvising trades on not respecting rules or rushing into trades, chasing the market, it's not a good recipe. Okay, so if I only got 3, and out of 3 I'm going to have 1 trade, so that's it. That's the trade of the day, and I'm done. I'm not going to force a trade. Or even if I had none, there are days where you sit on your hands, and it's part of trading. Okay. So what about sessions? Pre and post market gives us 34% probabilities. That is not acceptable. Regular session is giving us over 50%. So that is acceptable for directional trades. We shoot for minimum 50. Our reference point to get into the trade is 1885. So 1885 is, you know, somewhere here. Okay, which coincides with that UFO. Okay, so my friends, we are about to take this trade, because if that red UFO pushes price down just a little bit, it's gonna kiss the green UFO, right? So if price comes back down from here to here, it's gonna kiss the UFO, and this is our entry. Okay, this is our entry, just like that. Okay, so let's load the option chain for that guy, SKT. Okay, we only have monthlies available. This tells you that it's not gonna be the most liquid stock in the world. So hopefully we'll find enough liquidity. Now I'm going to start with planning my target. So if I was to plan my target, the target actually would not be too far. The target would be located at 1976. Okay, so that's quite disappointing, really. Only 1976. That's very disappointing. Very disappointing, because yeah, I'm very concerned about the liquidity here. So well, it's actually better than what I thought. Okay, let's give it a try. So 14.76. So let me add this. Did I say 14 or 19? Cannot be 14. 19.76. Okay, so 19.76, that's gonna be my target, and my entry is gonna be the green UFO we have in the 55-minute time frame, which is right here, which is 1910. Yeah, we cannot 1910. So we cannot do this trade as a directional trade where there is only 66 cents of profit. Because with the slippage you get with options trading, especially if I do a spread, you're just gonna get killed. Okay, so I'm just gonna approach the trade much differently than what I normally do when I'm directional. We are very likely going to do just a calendar spread. Okay, let me take a look at this, and I will confirm that in just a second. So because again, July 16 gives you up to $1.76 of price movement. That's 15 days. We only need 66 cents. So you could use the July 16. You could. But earnings for that stock are happening on August, right? And if that trade is not going to work well, I want to expose myself for an increase on the implied volatility of the stock. So August is that one, 20th of August. Okay, and this is where we're going to get to see more volatility kicking in. Okay. So let's do this. Okay, I'm not gonna go the route. This is probably something new. So I'm not gonna go the route of buying a call or doing a spread because there is no profit margin. Okay, all the way to 76, which is right there. Okay, that would be my target. So for an intraday trade or trading shares of stocks, that's great. But with the options and the slippage we get, I cannot use too many contracts. It's not gonna work well. So I'm gonna have to approach it differently. And basically, the way I'm gonna approach it, I'm gonna use a calendar spread. If you recall, we have done that before. A calendar spread is either made of buying a call and selling a call at the same strike, but different expiration dates, or buying a put and selling a put with the same strikes and different expiration date. Okay, and normally when we've used that before, we've used it as a non-directional technique. But what I'm going to do now is I'm going to use it as a directional technique. How can I make my calendar spread to be directional? Well, there is only one way. Is instead of using a strike close to the price, I'm going to use a strike close to the target. Okay, and since my target is 19 something, it seems natural for me to think of using 20 as the strike. Okay, also because we don't have 0.5s here. Okay, so do I have 20 on 16? And yes. Okay, so let's do this. So if I right click and analyze and buy a calendar spread, okay, so don't get confused, guys. So this is a calendar spread used as a directional vehicle, okay, which is not a normal thing. Okay, normally it's more of a non-directional thing. So and I'm tweaking it, okay, the way you saw, which is using using those strikes located towards the target. So what I want to do is sell the 16th of July, buy the August. So the one I buy hopefully will benefit from the increase of volatility when the stock is approaching earnings, even though it's pretty far in time. If this trade was to kind of range and do not much, so we can benefit from that. And then in parallel, so we have the July 16 expiration, which is going to lower the cost of the trade and basically pay us 67 cents per day. Okay, while we do have some positive delta. You can see it's plus 10 delta, so it's directional. It's not too directional, but it's directional. Okay. So if we were to do that, that could be one way to profit from this trade. This trade would have a cost of $68. Okay, it's going to be a bit less if you do it at entry. Instead of 68, it's going to be 65. So it's going to be a bit less. And then if the market goes, the problem is that you're going to make very little because the target is very close, so you're going to make very little. So what I'm counting on here is that a little bit of time will pass before I get to the target. And if I get to the target a few days after, ideally a couple of weeks later, something like that, so then, it's going to pay much better. Okay, that's what I'm counting on. Also, the other thing that I'm counting on is that, to be honest, even though my target is 19 point something, okay, as long as time keeps passing, actually I will profit all the way to 19, all the way to 21 something. Okay, so if you look at the chart, okay, if 21 is all the way there, okay, I will still be profiting. Even if the stock keeps going and going and going, I will still be profiting, even though it's less. And if the stock goes, deeper inside the UFO and below, of course, now I'm going to lose. But as long as it's above that, I'm fine. Okay, so I would say that probably this is the best setup possible, but I want to compare this with two more setups. So actually 3 more setups. So I'm gonna analyze, duplicate, duplicate, duplicate. We got 5 minutes. I think we should be okay. So I got multiple trades here that are duplicated. Let me do one at a time. Okay, so let me uncheck everything, and then I'll check one at a time. So the one on top is using the 20 calls, using August and July. The next one is what if we use the puts instead of the calls? Theory suggests it's the same thing, but sometimes it doesn't look exactly the same on the chart because there may be more implied volatility on the call side or the put side. There may be dividends priced in the put side or not, etc., etc. So we want to analyze both. And then the other thing I'm going to do is the same, but also using the 19 strike, which is going to be the trade to be a bit less directional. Okay, and I'm going to do that with the call and the put. Okay, so if you notice, I got 4 trades to compare: 20 strike, call and put; 19 strike, call and put. Everything using August and July expirations. Okay, so that's what I'm doing. So I'm going to compact everything. Okay, and TradeStation has this bug where if you don't change the quantities, it doesn't change the title. So we have calls and puts. So let me change the quantity. So when I compress, it changes the title. 19 calls. Okay, and 19 puts. Okay, so now that we have 4 trades in the bottom part, so let's go ahead and start simulating to see what's best. So with the 20 calls, we get 20 delta. The most we can lose is 65. The most we can make is 48. Okay, so it's not super exciting, but it's what it is. The target is very near anyway. So even if you were to buy shares and have a stop below, that's going to be like a 1-to-1, isn't it? Because the target is only 66 cents away. So that's why I am doing a calendar. I'm going to be in a position where my profit is not going to be that amazing, but at least I got other Greeks working for me instead of only direction, since having the target so far would basically have me discard the trade altogether if I was purely directional. If I look at the puts, what happens? Well, if I look at the puts, the risk of the trade is going to be $90. So the puts are going to be more expensive. And they're going to pay me same $48. Okay, so no puts. The calls are better. Now, what if I use the 19 strike? Well, if I use the 19 strike, it's going to cost me 65. Okay, same price. And the most I can make is about 46. But now my delta is a bit negative delta instead of positive delta, so it doesn't seem too convincing. What about the put side? If I do the put side, it's going to cost me 87. The most I can make is 42, and the deltas are -2. Okay, so yeah, so in the end, experience was leading me to the right place by using the 20 calls for the calendar. So this could be a trade to be taken. It seems that the slippage here is 15 cents for 2 contracts. So it's fairly reasonable. The midpoint is 68, but you don't need to take the trade now. You need to wait for when the market comes to the entry and then get into the trade. So what I would do in this particular case is just to have some sort of an alert system. Okay, some sort of an alert system. So you are alerted when the price hits the green UFO, and then you go place the trade manually so you can shave the spread as much as possible, because it's going to make a big difference. Okay, it's going to make a very big difference if you shave the spread, because again, instead of making 49, you make 55, and instead of risking 65, you risk 60, and you have really improved the reward to risk ratio of the trade, isn't it? So you need to work on that, especially in a stock that is probably not the most liquid in the US market. Okay, so you gotta place yourself some sort of an alert. In my case, for practice purposes, I'm just gonna go ahead without an alert. I'm gonna have a conditional order, but I'm gonna just do a market order, so I make sure I get filled, so then I can demonstrate this trade for you guys. So SKT, we are doing a 20 strike calendar spread. So we are buying August, selling July. This is correct. I want to do this with a market order. Okay. And I'm going to do it for the day, but only if, oh, I just got filled on the roll, guys. I got filled on the roll with AMD. Okay. So SKT, if SKT is less than or equal to 19.10, that's my condition for an entry. Okay. And yeah, so that's what I need. Okay. So I'm just gonna place the order. I am buying the calendar with a price condition, with the stock being less than or equal to 19.10, and I confirm and send, and now the order rejected. The order cannot be accepted because system is missing quotes to validate it. Okay, well, I won't be able to practice because this is a simulated account with Thinkorswim, and if it's missing quotes, then it's not gonna accept my order. But maybe I can trick it. Let me see. Maybe I can do. I think I can trick it. Let me see. If I do a calendar spread, and instead of a limit order, I'm just instead of a market order, I'm just gonna say $1. Okay, which is more than now. So, and I add my condition again, 19.10. Okay, so let me see if it takes it like that. Okay, a limit order of $1 will get me filled at $1 or less, which is going to act as a market order if you wish, because the price of that calendar spread is supposed to be 65 cents when it gets to the entry point. So let's see if that way it takes it. And it seems that I did trick it. It took it. So here is the order waiting to get filled. Okay, so again, I am a bit persistent there to try to get that order filled. Okay, why? Well, because, you know, this way, you know, for sure, I'll be able to explain what happens during the trade, you know, all of those things, which are very important for you to master. Okay, so that's why. But between us, it's a good trade to practice, especially because it only has $65 of risk. But it's not a trade where you're gonna make a lot of money, isn't it? So you know, like all other trades, you know, you're gonna have to decide if you want to take it or not. But obviously, this one, if you take it, like I mentioned last week with MDT, it's a good trade for practice purposes, but not much more than that. Okay. Anyway, so I'll have a vertical line there. This is when the trade was planned. Okay, the target was 1976. Okay, 1976. Here we go. So that's the target. And yeah, so we'll see. So this trade is made of buying the 20 and the 20 call, okay, expiring in August/July. Okay. Anyway, my friends, we just reached. Yeah, you got filled on the GS roll. Perfect. We just reached the end of the session, everybody. It's a pleasure to have you join me as always. It's a pleasure for me to conduct the sessions too. Let's see how things go. Keep up the good practice. Send emails with questions if you have. And I will see you next week. Keep up the good work, everybody. Take care. See you soon. Bye-bye.